Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey, Prime investors, Martin Maxwell here. Welcome back to the 5-Minute Prime Podcast. Over the last few weeks, we've talked a lot about the exit. We covered 1031 exchanges and Delaware statutory trusts, strategies for moving your equity from one property to another without paying the tax man. But let's play a game of pick your poison. Option A, you sell a rental property for a $200,000 profit, you feel rich, but then April 15th comes. You owe federal capital gains tax, you owe state taxes, and you owe the IRS for depreciation recapture, paying back all those tax breaks you took over the years. You might write a check for $50,000 or $60,000. Your wealth just shrank by 25%. Option B, you keep the property, you go to a bank, you execute a cash-out refinance. The bank wires $200,000 into your account. You can spend it, you can invest it, you can do whatever you want with it. And the tax bill? Zero. This is not a loophole. This is architecture. This is how the wealthy operate. They don't sell assets, they borrow against them. They live on the bank's money while their assets grow tax-free. But there is a catch, a massive one. If you put that money in the wrong bank account, or if you hold that property in the wrong type of legal entity, you could accidentally trigger a tax nightmare or lose your deductions entirely. Today, we are mastering the art of refinance tax planning. We are shifting gears today from the invest phase to the manage and expand phases of the prime framework. We are dealing with sophisticated leverage and IRS regulations. So the standard critical warning applies. I am not a CPA and I am not a tax attorney. The strategies we are discussing, specifically interest tracing and entity structuring, are complex. If you execute this wrong, you can trigger taxes you didn't expect. Do not attempt this without a qualified tax strategist on your team. Understood? Good, let's unlock the vault. To understand why debt is the ultimate tax tool, you have to think like the IRS. The IRS taxes income. But what is income? The Supreme Court defines it generally as an accession to wealth. Basically, did your net worth go up? When you get a paycheck, your net worth goes up. You have more cash, no new debt, that is taxable. When you sell a house for a profit, your net worth goes up. Realized gain, that is taxable. But when you do a cash-out refinance, look at your balance sheet. You get $200,000 in cash, an asset, but you also get a $200,000 mortgage, a liability. $200,000 minus $200,000 equals zero. Your net worth did not change. Therefore, there is no accession to wealth. Therefore, there is no tax. My point of view is this. This is the cornerstone of the buy, borrow, die strategy used by billionaires. You buy assets. You borrow against them to get tax-free cash for your lifestyle or new investments. And when you die, your heirs get a step up in basis, wiping out the capital gains tax forever. It creates a tax deferral supercycle. You are using the bank's liquidity today while keeping the asset's appreciation for tomorrow. But you have to be careful with the interest. And this is where most amateurs fail. The tracing trap, Treasury Reg 1.163-8T. I see this mistake constantly. An investor does a cash-out refi on a rental property. They take that $200,000 and dump it into their personal checking account, right next to their grocery money and their Netflix subscription fees. Then they use some of that money to buy a new rental property and some to pay for a vacation. Come tax time, they tell their CPA, deduct all the interest on the new loan. It's secured by a rental property, so it's a rental expense, right? Wrong. The IRS follows a rule called interest tracing, Treasury Regulation 1.163-8T. Here is the rule. Interest deductibility follows the use of the funds, not the collateral. It doesn't matter that the loan is on a rental. If you use the money to buy a boat, that interest is personal interest and it is non-deductible. If you mix the loan money with your personal money, you create a mixed mess. The IRS forces you to use complex accounting rules to figure out which dollar bought the rental and which dollar bought dinner. If you get audited, you will likely lose the deduction because you can't prove it. The pro move, you must create a clean conduit. Before you close the refinance, open a brand new segregated checking account. Have the title company wire the $200,000 directly into that empty account. When you are ready to buy your next asset, say to hit that December 31st deadline for bonus depreciation, you wire the money directly from that segregated account to the new purchase. This creates a perfect, unbreakable paper trail. You can prove to the IRS that 100% of the loan proceeds went to a business investment. Therefore, 100% of the interest is deductible. Do not commingle. Segregate. The S-Corp Landmine. Back in episode 105, we talked about why S-Corp are great for active income, flipping, but terrible for holding rental assets. Today, you find out why. If you own your rental property in an LLC and you do a cash-out refinance, you can distribute that $200,000 to yourself tax-free. Why? Because in a partnership, you get basis for the debt. But if you made the mistake of putting that rental property inside an S-Corp, you have a massive problem. In an S-Corp, shareholders do not get basis for third-party debt. If your basis in the S-Corp is low because you've been taking depreciation for years, and the S-Corp distributes that $200,000 loan cash to you, the IRS views that distribution as a capital gain. You read that right, you borrowed money and you have to pay tax on it immediately because the distribution exceeded your stock basis. You just turned a tax-free event into a taxable one. My point of view is simple. Never hold appreciating real estate in an S-Corp. If you are in this situation, do not refinance without talking to a very expensive tax lawyer first. You might be stuck. The 2025 golden window rate arbitrage. Finally, let's talk about timing. Why are we talking about this now in late 2025? We are in a unique window. Interest rates are hovering around 6.5%. Is that cheap? No. But inflation is creeping back up, and the Fed's dot plot suggests rates could go higher in 2026. This is rate lock arbitrage. If you refinance now at 6.5% and you use that capital to buy a new asset before December 31st, you can capture the 40% bonus depreciation rate before it drops to 30% next year. Think about the math. You pay 6.5% interest, but you get a tax deduction equal to 40% of the new asset's value in year one. Plus, you get the cash flow from the new asset. If the combined return of the tax savings and the new cash flow is higher than 6.5%, you are winning. You are using the bank's money to lower your effective tax rate. But remember, this requires speed. Lenders slow down in December. If you want to execute this play for the 2025 tax year, you need to start your loan application today. Let's recap. Refinancing is the alternative to selling. It allows you to access your wealth tax-free, but only if you respect the tracing rules by segregating funds and avoiding the S-Corp trap. Your challenge today, I want you to do a balance sheet audit. Look at your properties. Do you have significant equity trapped in a property earning 0% ROI? If you have a property with 50% or 60% equity, calculate how much cash you could pull out while keeping a safe LTV. If that number is over $50,000, ask yourself, could I deploy this into a new deal before December 31st to get a tax break? If the answer is yes, call a lender, get a quote. Next episode, we are going to talk about the danger. Leveraging up is great for taxes, but it increases risk. How do you ensure you don't over-leverage and lose everything when rates shift? We're building the 2026 portfolio stress test. I'm Martin Maxwell. Keep learning, stay strategic, and keep building one step at a time.